where it's actually unfolded is that it's actually played out in the precious metals market first, and then that's when we're anticipating a catch-up move in Bitcoin. But the sentiment over the desk over the last few weeks, we're actually seeing a bit of early bullish green shoots. So whilst people had a rough close to 2025, the sentiment as of now has been, where should we put our limit orders? Where should our dollar cost averaging start? What should be the capital deployment size? So whereas before the conversations in late November, even early December was around, should I be selling? Should I be exiting the market? Should I wait for a better time to come back? Now the conversations have been a bit more around, look, we're ready to deploy capital. We're excited to come into the space, but they're just being a bit conservative. They think that they can walk away with more Bitcoin for their dollars by being patient and having some sort of limit order or dollar cost averaging strategy, which has been a nice turn in the market. From a technical perspective, which is what I'd love to kind of riff with you about as well, a bit of the technicals and fundamentals, is that whilst the market and the charts look completely like dog's breakfast, I actually like the fundamentals now more than ever before, because we're seeing this bifurcation in US dollar hegemony. We're seeing a lot of politicking, particularly around the moves around Greenland. We're seeing Japanese bond yields just going vertical. We talked about that quite extensively last time around. And Bitcoin has never been, in my humble opinion, cheaper than where it is today relative to global assets and global liquidity. And so that's where I feel that there's a mismatch between price and value. So whilst price is 88,000 and not looking, all that stellar, the mismatch between where I anticipate us to be is quite attractive. And that's something I'd love to unpack with you as well, because I love your perspective and your analysis as well.
Mm. Just looking at it from, I'm just thinking about audience. So they're mostly everyday investors. They're not sophisticated in the sense that they spend all day watching Bitcoin videos. They don't spend um, time analyzing charts. They're busy working, running businesses, working in jobs, and trying to grow their net worth over time through investing. And so, from that perspective, like, I guess what they're top of mind for them right now is, why isn't Bitcoin pumping? What's driving this downward pressure right now? Because we trust Adam and we trust Bish and we're excited about it and we've read the books and watched the videos. Everything else seems to be running. Why is Bitcoin lagging so hard? Did I buy too late? Have I missed the train? Is this yet another example of me being emotional and I'm going to lose again? Which is
Mm.
so many people's reality that are coming out of working class roots and trying to get ahead through crypto. So, what do you have a thesis for, like, why we're not seeing it specifically right now? Like, what's going on right now in the markets that they could make sense of it with? And I've got some other stuff to talk about it as well.
Yeah, I mean, the two main reasons, in my humble opinion, is one, it's what we talked about last time when I was on the show, which is the Japanese bond yields absolutely spiking and ripping through the roof. Because again, and I'm happy to unpack it for those who didn't watch it, Japan for the last decade and a half has been the world's cheap credit factory. It's where massive institutions and even large, sophisticated, high net wealth individuals would go and park a lot of their capital, borrow against their US dollars, borrow against their US treasuries, because when you borrow in Japan, the interest rates were at zero. You could afford to borrow a boatload of capital and have pretty much close to no cost of borrow. So it was a no-brainer of a trade. And then you would take all of that free, cheap capital and you would put it back into the system. You'd buy real estate, you'd buy assets such as Bitcoin, US assets such as equities like technology assets, Nvidia, Apple, Microsoft, the whole shebang. And then what happened is, over the last little while, is we've been seeing what is known as a sovereign debt crisis. What that effectively means, for those who are just watching at home, and maybe that's the first time you've heard somebody string those words together, it's essentially when global markets do not believe governments are in a position to repay the debt that is owed to them. So in capital markets, one of the biggest markets in the world is the bond market, but you don't hear about it a lot in headlines because it's not a very sexy market. But it's what drives the price of everything, because it's what is known as the risk-free rate. So in America, they're holding about $38 trillion worth of debt. and their debt to GDP ratio is about 120%. Japan's a little bit worse. Their debt to GDP ratio is over 200%. So when bond investors or institutions no longer feel that the government that they've lent the money towards and they're earning, say, 2%, 3%, 4% yield on borrowing to the government or lending to the government, because the likelihood of a government becoming insolvent is very slim. And so they can essentially give to the government billions upon billions of dollars with the fact that 20, 30, 40 years from now, they're going to still be around in order to repay that initial loan that was provided to them. Now, what's happening is that they're feeling like, yes, they can repay us on a nominal basis, but they're worried about hyperinflation. So that's when the government, such as the Bank of Japan, will print a boatload of Japanese yen and repay investors their owed loan. But because the yen is worth 30, 40, 50% less than what the loan was initially lent to them, they've lost out in a big way. So they were made whole on a nominal basis, but the actual purchasing power has been eroded away. Same deal with America. So America's debt market is $100 trillion. To give you an idea, that's 55 times larger than the Bitcoin market is. So any small fluctuation in the yields in America or Japan downstream will have a magnified effect on the price of assets such as US technology assets and Bitcoin, of course, as well, being a much smaller asset class. So that's the number one driver, is the concern around large sovereigns such as America, Japan, being able to repay their debt in a nominal basis. And so people are exiting the system. And that exit would, I believe, will eventually be Bitcoin, but it hasn't been the first go-to choice. Institutions are flocking towards precious metals, particularly gold and more recently silver, as that has been money for 5,000 years. So in periods of crisis, when large sovereigns, whether it be the Roman Empire, whether it was the British Empire, the Dutch or Spanish empires, and now more recently the American Empire, is looking unlikely to repay its debts, people exit those economies and go into a neutral asset. That neutral asset has always been gold. We haven't had Bitcoin before. For 5,000 years, it was always just shiny rocks that we pulled out of the ground. I believe that that transition into Bitcoin will play, that's where the catch up trade will be. But answering the first part is sovereign debt is the biggest concern, and that's what's driving on it. And secondly, we've been correlated with risk assets for the last few years. So, especially since the COVID injection, the liquidity injection that came in at that time, Bitcoin has been trading in lockstep with technology assets. So the correlation should have had us ending up a lot higher. But the 10th of October, which was that large liquidation cascade that we had seen, broke that correlation, unfortunately, to the downside. So it's a twofold factor where I believe it's just short term. It's not a long term positioning that will affect Bitcoin's price. But short term, there's a lot of concern about sovereigns being able to repay their debt. So people are flocking to gold and silver. Therefore, Bitcoin isn't yet treated as a safe haven asset, so it's not catching that bid. And more recently, it's been trading as a high risk technology play. And because that correlation was quite high over the last 5 years, and then we add on top of that the leverage cascade that we had on the 10th of October, you've got this really weird middle child syndrome unfolding at the moment, where it's not quite a safe haven play like gold and silver is, and it's not quite a risk on play such as the technology assets that we've seen. And it's kind of breaking away from that risk on correlation and trying to move towards that risk off play. But that's why it's kind of in this weird limbo land where we've been trading between 88K and 94K for the last 2 months. But that flip, when it comes, that repricing is going to be incredibly epic. It's going to be quite fast. But right now, the reason why the price has not quite caught up with the fundamentals is because of the localized liquidation cascade on the 10th of October. And then also the fact that we're seeing a lot of risk off sentiment in the market. So you have that is really what's led us to that price point at that on Bitcoin today.
Dude, that's so insightful. I love that.